Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 34 of our YouTube channel and podcast, and I could not be more excited to continue talking to you guys about these personal finance topics that I think are hopefully really helping you and teaching you a lot about just different things that maybe you weren't aware of or that could really help you to fine tune or completely turn around maybe your personal financial life. One big issue when it comes to investing is tax efficient investing. And so today, what we're going to talk about is one part of tax efficient investing, and that is the tax deferral or tax free advantages that certain accounts offer and that you can take advantage of in order to decrease your tax burden either today or later. Before we get started though, you know the drill. Go down below, click the subscribe button if you haven't already. Like this video, click the big like button. Leave me some feedback in the comments if you'd like, and I'll get back to you and we can have a little dialogue about maybe something that I talk about today that interests you. You can also go and you can subscribe to the podcast version of this show on Apple or Spotify podcasts and subscribe to us there. Leave us a review there. That'd be much appreciated. Also, follow me on social media at MNO with Dylan, and check out my website for information about the financial coaching services that I offer, and that's www.mnowithdylan.com. Now let's jump right into tax efficient investing when it comes to tax deferral and tax-free options. So first of all, why does tax efficient investing matter? Why do we have to worry about taxes in our investing? Well, simply put, taxes are going to eat away at your returns. And we don't want our returns eaten away. We want to keep as much of the growth of our money as we can. So just right off the top, we know that taking care of things that we can do to minimize taxes is going to be beneficial to us in the long term. And if you're having to pay taxes on gains that you've made, then you're naturally losing the money that could still be working for you if it were still growing in a tax-free or tax-deferred way. And always understand that your after-tax net returns are far more important than your gross returns. So if you see somebody just talk about gross returns of a mutual fund or gross returns of a fund manager or an asset manager, make sure that you're also looking at their net returns, not just net of fees, but also net of taxes, because tax efficient investing can save you a lot of money and can actually make you a lot of money in the long term if done correctly. So tax efficient investing really takes into account two things. It is both the types of accounts that you are invested in and the things that you use to grow your money or that you actually invest in within those accounts. And so let's first talk about the different types of accounts. First off, there's taxable accounts. And so you've heard me before talk about brokerage accounts and just simple brokerage accounts. Those are taxable accounts. The gains that you make on things within those brokerage accounts, you will pay taxes on those gains. Now, taxable accounts are naturally going to allow you more flexibility and less restriction than accounts that have tax deferral or tax-free advantages, but you can lose out on some returns that you could have kept net of taxes, net of fees, if you were to have some of those advantages, some of those tax-efficient advantages that those taxable accounts just don't have. Then there are tax advantaged accounts, and that's going to be kind of our focus, are these tax advantaged accounts. Now, we've talked about several of these that I'm about to kind of spout off at you, but there are two types of tax advantages. There is tax deferral, and then there is tax exemption or tax free. Okay? And so the tax deferral, the accounts that allow for tax deferral are your traditional 401k, your traditional IRAs, your 457 deferred compensation plans. You are getting a tax break up front and your money is growing tax deferred. And by deferred, what we mean is you don't pay the taxes today. You actually get the tax break today, but you do have to pay the taxes when you pull the money out later on. And then tax free or tax exempt accounts are those typically that begin with the word Roth. And so if you hear Roth, you think tax-free, because you contribute after tax dollars. You've already paid taxes on the money that you're investing, and that money grows tax-free. You never have to pay any taxes on the growth, and then you pull the money out, you make withdrawals tax-free later. So these are tax-free accounts, and those can be Roth IRAs, Roth 401ks, Roth 403bs, things like that. Anything that begins with Roth is going to have this particular tax advantage to it. These two different types of tax advantaged accounts, tax deferred and tax exempt or tax free, are going to be the focus of what we talk about today in being tax efficient with our investing. There's this question that we have in investing that is a big dilemma and is a big question in personal finance circles, and that is Roth or traditional, meaning tax free or tax deferred. And this is not a binary decision. It's not a decision based on just one thing. This can be very complex to determine which is going to be best for someone long term. And basically the decision is just between paying taxes today and getting tax-free money later, or paying no taxes today and deferring your taxes to a later date. So I'm going to give you my view of how I feel about Roth versus traditional. And so first off, I want to say Roth should be the answer in most cases. Now, people will make this argument. They'll say, well, if you expect to be in a higher tax bracket later, then you should do Roth. If you expect to be in a lower tax bracket later, then you should do traditional, right? Because the money that you're putting in, you're deferring taxes. So you want to defer taxes to a time when your tax rate is lower with traditional. And if you're doing Roth, you want to get tax-free money when your tax rate is higher later. And that's a logical thought, but they fail to take growth as a vital factor in that equation. Because with tax-free or tax-exempt accounts, Roth accounts, your money, your contributions are tax-free later, but so is the growth of the money. And that's the problem. When you put money into a pre-tax account or a tax-deferred account, then what happens is it's going to grow, but the growth you will end up paying for when you're taking money out. You're going to pay taxes on that growth as well. And with Roth, you just don't have to. Because in most cases, what you're going to see is that especially if you started early, the money that you put into a Roth account or a pre-tax account, any type of account, if you start early, it's going to be a vast majority growth if invested in the correct things once you go to pull it out. And if this is the case, then when you're pulling money out, it's not going to take long to get past your contributions and actually get into the growth money. And so if I don't have to pay taxes on the growth, the money that I didn't even put in there to get tax advantages in the first place, then that would make the most sense, right? So this is my thought and my recommendation as far as Roth and traditional. This is just the way I think about it and the way I plan to do it. The only reason someone should logically choose a traditional over a Roth or tax-free option is if they have very little retirement savings and they are in peak earning years. Because if you are already in peak earning years, well, what does this mean? This means that you are probably paying the most taxes or the highest percentage of taxes that you will ever pay, likely. And so if you're already in that place where you are in peak earning years, then you can be relatively assured that your tax rate is likely to be lower later on or in retirement. And if you know this is the case, then yeah, it would make some sense to go ahead and get a tax break today on my high tax rate and actually have to just pay a lower tax rate later. That would make sense. But in a vast majority of situations, first of all, we don't know what tax rates are going to be. Yes, they are extremely low right now. And so that makes even more the case for Roth, because you're putting in after-tax money you've already paid taxes on. So if your tax rate increases over time, then yeah, you won't have to pay those taxes. It's tax-free money later on. But there's such a risk. I mean, given a political change, an election that that particular candidate wants to do big tax reform, and taxes change a lot. And so if somebody wants to do that, they can. And what will end up happening is you may get your whole strategy flipped on its head because you didn't know what taxes were going to be later on. I can almost guarantee you that those who were saving in the 90s had no idea that taxes would be as low as they are today. So this is a big risk to try to play which side of it you want to be on. Personally, I want to be on the side of tax-free. I don't want to have to pay taxes later, and I don't mind paying taxes now. So just get the taxes out of the way and put the money in, let it grow, and take it out for free later. And that just sounds like a really good plan to me, unless somebody's in that particular situation where it's just obviously more beneficial to put money in a pre-tax account and get those tax breaks now and pay less taxes likely later. Then there are some other types of tax advantaged accounts that you can take advantage of that can really help out and can really do you a lot of good in your quest to be tax efficient in your investing. So not just Roth versus traditional, which is a big part of this argument, of this conversation, but there's also things like health savings accounts. Now you might say, well, Dylan, a health savings account, isn't that for medical expenses? Exactly. It is for medical expenses, but there are caveats to health savings accounts that allow you to invest in a tax efficient manner. And I'll tell you how. So health savings accounts are what we call triple tax advantage. Now, what does this mean? Well, not only do you get the tax break for the money that you put in. So if I put in $500, I get a $500 deduction on my taxes that year. So not only do you get the deduction for that year, you get the deduction, the money grows tax-free, and then when used for qualified medical expenses later, you can take it out tax-free. So it's triple tax advantaged in that way. Now, there's other fun things about health savings accounts as well, because they're a little more nuanced than that. In these health savings accounts, you can actually invest the money. And most people don't know this. Most people don't know that you can invest via health savings. So putting that money to work there can allow it to grow and get more tax efficiency and allow your money to grow for you in an acceptable way, in a really good way. Now also, and this is the really, really fun part, let's say you've been healthy most of your life and you haven't had to pay a whole lot in medical expenses, and you've had an HSA qualified health plan, and you've had an HSA all these years, and you've been just building funds in your HSA every check, and you get to age 65 and you've still got a substantial sum in your HSA. Well, a lot of fun is coming, because then it acts like an IRA. You can actually take the money out and not use it for health expenses once you hit age 65. So it's like an IRA in that way. You just have to wait a few more years. And as you're going, you can use it for qualified medical expenses. So this triple tax advantage is an amazing thing to take advantage of. But the caveat is you have to be enrolled in an HSA qualified plan in order to have this benefit. But if you do have it, you should be taking advantage of it, because it's such a huge tax efficient investing tool. And then we've talked about before college savings accounts, so I'll hit on the 529 plan here. The 529 plan also has some tax advantages to it as well, and those tax advantages are the following. After-tax contributions into the 529 plan grow tax-deferred, and then if they are used for qualified educational expenses, then they can be taken out tax-free as well. And 529 owners can take money out of those 529s at any time for any reason, but the earnings portion of the account, so the growth, will be taxed at your income tax rate plus a 10% penalty. So that's why it's not really smart to take out 529 plan funds early, but you can see how the tax deferral and the tax-free withdrawals later on can play such a big part. And on the front end, in many states, and it's a state by state thing, as we've talked about before, you can get state tax breaks for the money that you put in, the contributions that you make to a 529 plan. So again, tax deferral and tax exemption, really useful tool in tax efficient investing. So this is all one big balancing act, right? And you want to make sure that you get the tax advantages that you should, but maybe you don't go too far towards just getting tax advantages at whatever cost. Because first off, some accounts are restrictive in your ability to withdraw or your ability of how much money you can put in. So IRAs, 401ks, 529s, all these types of things, health savings, they have restrictions to them, but they do have these tax advantages. So you can't throw the baby out with the bathwater, as they say, and just put all of your money into all of these tax advantage things because they'll allow you to defer or exempt taxes at some point in the future. You can't just do that because then you're going to have a liquidity crisis. You're not going to be able to get your hands on your money, and that's a problem. You need to be able to get your hands on your money in some capacity. I'm not saying all of it. Most people, a vast majority of their net worth is in tax advantage accounts, and that's fine. But we need to remember that we do need emergency funds that are liquid. It is nice to have certain things that you're saving for in a brokerage account or whatever that may be. You need that money liquid, and so just throwing out all of your liquidity just for tax advantages can be a dumb thing to do. So make sure that when you're balancing these things, find what works for you, but make sure that you maintain a good amount of cash position, liquidity position that's not in these restrictive accounts. So what are some actionable steps that you can put in place in order to take advantage of these tax efficient investing strategies and tax efficient investing accounts? Here's a couple of particular things I think you can do that could help you depending on where you are in life. Obviously, this is not one size fits all, but these are just some general recommendations and general thoughts that I have about how I'm going to manage my own money moving forward. So here's some things that I do specifically, just so you'll have an idea of how I think about my own finances and how me and my wife go about managing our investments in a tax efficient way. So here's some things that we do. First of all of our retirement money, all of the contributions that we make, all Roth. We're young, we don't want to pay taxes later, and so a way that you can ensure that that's not going to happen is you go ahead and put all your money in Roth assets, all of your retirement contributions in Roth assets. We do so through both Roth 401ks and Roth IRAs. So you can do that, and that's a big thing for young people, allowing your money to grow. And that's my thought process: is I'm allowing my money to grow tax free. Then later on, I'm going to pay no taxes, and that's going to be awesome. So just my way of looking at retirement investing, especially at my age. You may say, well, Dylan, you're always talking about a match. Well, isn't that pre-tax money? You're not going to have all Roth assets. Do you have a match? Well, yes, my wife's employer matches her contributions actually up to 4%. And so what we plan to do, yes, that's all pre-tax money. Well, whenever the time comes that we have to roll that money out into an IRA, then what we're going to do is we are going to convert it to Roth. Now, it can be a large amount of money. It can be a large tax bill when you convert to Roth. And so just depending on how much money that actually turns out to be, you may have to do the conversions in steps, or you may not be able to convert all the money. And so we might not be able to do all of that, but a vast majority of what's going in is contribution already. So it's just one of those things you have to balance, and you have to make sure that you remain in a lower tax bracket if at all possible, because that's a big part of tax efficient investing, is making sure if you are doing conversions, if you are converting traditional into Roth, that you're not bumping yourself up in tax bracket for no reason. And so we have to keep that in mind, but I do plan on converting a lot of that money into Roth assets. And then when it comes to the idea of an HSA, we don't have an HSA qualified healthcare plan. So if I could take advantage of an HSA, I definitely would. The triple tax advantage would be awesome, but that's just not a part of what we have going right now. So taking advantage of an HSA is just not there. But, like I said, if I could, I would, because it is such a great tool. And then when it comes to college savings accounts, well, we don't have children yet, but I do some investing for different purposes in brokerage accounts. And I kind of have mixed feelings on the college savings accounts, like I've talked about previously, because of the restrictions and the amount of money you can put in, and the investment options that you get may be restricted based on your state if you're talking about a 529 plan. So I do put money in brokerage accounts. Yes, that's not going to give me any kind of tax advantages. That's going to be all taxable account, but my investment options are going to be generally better, and I'm going to be not restricted in the money that I can take out or put in any amount at any time. So that's a good thing. But my ideas on this might change as our life situation changes, and as maybe we have children in the future, then that is going to have some bearing on the decision that I make. But for now, no 529, no ESA, no anything like that. But stay tuned. That may change in the future. And then something that I'm always doing is just staying diligent. I mean, making sure that I understand how much we're paying in taxes, where we can get tax advantages and tax help, how we can go about minimizing our tax burden of the investing that we do. And one big part of that are these types of accounts that we've talked about, these tax-free and tax-deferred accounts. These tax-advantaged accounts are going to play a huge part for us in the future. And the reason I say that they're going to play such a big part in the future is because a lot of our money is tax-free money. So we've already paid taxes on it, but we're playing the long game and saying, okay, well, later on, either us or our beneficiaries, no taxes. And so I love that idea. And so I'm making sure that I'm staying on top of tax brackets, staying on top of different abilities to minimize taxes through these types of accounts. And you should be too. You should be paying attention. Don't fall asleep at the wheel. Be diligent, know what's going on, and learn. And that way you'll be able to make the best decision for yourself later. So what you need to understand is when you invest, you do have the ability to minimize your tax burden either today or in the future. So don't just make decisions on investing based on what stock you like or what mutual fund you like or what security you want to invest in. Don't just make those decisions. Also pay attention to the accounts that you're putting them in and the advantages that those accounts offer or the disadvantages that those accounts offer and what's going to work best for you long term. Don't get me wrong, there are going to be restrictions when there are advantages. You just have to balance those out and determine what's best for you in the long term. Like I said, I do a lot of this type of investing in these tax advantaged accounts. But that doesn't mean that I'm sitting on a light liquidity position. You have to make sure that you're also keeping adequate cash to deal with emergencies and things that come up and to be able to live your life and not just try to dodge taxes your entire life. So know that these exist. Do your homework, be diligent, but don't fall asleep at the wheel. Make the right decisions for you and your family. So hey, I appreciate you guys watching this video. This is a topic that should apply to everybody. This is something that I think we can all take advantage of in one way or another. And we all have access to these types of things one way or another, whether it be just IRAs or employer-sponsored accounts or whatever it may be. And so I really appreciate you guys paying attention and watching this video and wanting to learn more about investing, and specifically today, tax-efficient investing. And so if you could, just make sure you go down below, subscribe to the channel, click the like button, leave me any comments, some feedback down there that I could get back to you on, and we can start a conversation about your personal financial life. If you want to have a face-to-face conversation, you can always check out my website and my financial coaching services that I offer at www.mnowithdylan.com. You can also follow me on social media at MNO I put a lot of good stuff out there for you as well. If you're listening on the podcast, just make sure that you go and subscribe there and leave me a review if you'd like on Apple or Spotify podcasts. And then check out tomorrow's video. We're going to continue with tax efficient investing, but tomorrow we're going to specifically talk about capital gains taxes and how that plays a part in your financial life, in your investing life. So be looking out for that. Also be looking out for the little clips. I'll put out a clip of this video this weekend, but there'll be 5 clips, one for each of the videos that I've put out this week that comes out this weekend, and you can check those out on Saturday and Sunday. And they're shorter clips that will allow you to get the idea of what I talked about in each video. So hopefully you'll enjoy those, and maybe you can go back to one of the videos that you missed if that topic was particularly interesting to you. So hey guys, thanks a lot. Thanks for tuning in to this episode of Money's No Object. I am your host, Dylan Howell. God bless.